Better and easier trading setups, it's what you're going to have after this video. You will be able to analyze a market and look for the high probability trades properly. This is done by top-down analysis, so make sure to pay attention and let's start this video. Top-down analysis is a process of implementing all the type of time frames into your trading plan. The top-down analysis follows a simple order from macro to micro, that meaning that we start from the high time frame, which is usually the daily and weekly time frame, into the medium time frame, which would be the 4-hour and 1-hour time frame, into the low time frames, which would be the 15-minute, 5-minute, and 1-minute time frame. These are the three types usually used in trading. The high time frame is usually used to understand what is the macro direction of the market. In other words, where does the market looks to be trending? The medium time frame is used to analyze potential opportunities and trading setups. This is the time frame where we look for directional liquidity structures and short-term price action analysis. And finally, the low time frame, which is used for the execution of the trading setup itself and managing the setup, like planning the take profit and stop loss levels, and as well as looking for room of error, which are short-term price action movements that give us clues against our trading plan, making the setups being lower quality. This is a thing that we are going to talk on the charts. Timeframe alignment is simply explained as a rule that traders using the top-down analysis will prioritize relevant timeframes related to the order, as I said on one of my previous videos. The best way to avoid mistakes is to first explain them. So a mistake in timeframe alignment and relevancy would be looking at the daily chart, so starting the analysis right there, and switching to the 5-minute chart. This does not help us at all. Why so? Because the timeframes are too distant from each other, making both analysis irrelevant and close to useless to our trading plan. Now that we know what not to do, we can look at how time frame alignment is really done properly, and it all depends on the type of trading you do. If you are an investor, the time frame order could be like this one: macro analysis to identify the high time frame direction done on the monthly chart, current trend and setup opportunities on the weekly chart, and the setup execution on the daily chart. For swing traders, it could be directional macro identification on the weekly chart, current trend and setup opportunities on the daily chart, setup execution on the 4-hour chart. And for day traders, and specifically intraday traders, it is the same order as the swing traders besides the last time frame, where the setup is not done on the 4-hour chart, but it is done rather on the 1-hour chart. And lastly, the scalpers, starting from the 4-hour chart, into the 15-minute chart, into the 5-minute or 1-minute chart. Before going to the charts, we need to know a couple trading concepts that will be used in confluence to the top-down analysis. We have talked about them in the past video in a more basic way. I will do a quick recap for the newcomers and also go into more detail on how top-down analysis can be used with these concepts. The first concept is the simple supply and demand. The demand is a zone drawn from the last candle before an impulsive upside movement. The zone it is drawn by the full candle, including the wicks. And the idea of the demand zones is that a huge impulsive move is usually done by the market makers or institutions, or whoever large trader has moved this market will probably have intentions of entering into the same position once the price pulls back into the demand. The reason is that these large institutions don't instantly enter into just one very large trade, but they split a very large trade into multiple smaller trades. That was the whole theory simplified. So when the price comes back into the zone, we want to make sure our analysis was done properly, so the demand is valid in a way that the price will reject to the upside from the demand, giving traders an opportunity to look for buy-long setups. On the supply zones, it has the same logic, just with the direction flipped. So the market makers or whatever institution heavily pushed this market to the downside has left some footsteps on the chart, and they are in form of a supply zone. The supply is drawn from the last candle before the impulse to the downside. All the candle is taken into consideration, including the wicks. And the whole logic is that the market has a high probability of rejecting the supply to the downside if the price shortly goes there afterwards, therefore giving traders a good opportunity to look for sell-short setups. The other trading model are imbalances, so-called inefficiencies, and also fair value gaps. You probably know them under this name. The logic behind the fair value gap is similar to the supply and demand, just the positioning is different. The logic is that someone or somewhat has pushed the market so much that it created a price inefficiency. An inefficiency in price is looking like an empty space between large candles. It's usually seen on a sequence of 3 or more candles, from which we have the impulsive candle itself, which is the second candle, the candle before the impulse, which is the first candle, and the candle after the impulse, which is the third candle. The main point is that on uptrends, if we take the higher wick of the first candle and connect it with the lower wick of the third candle, if there is an empty space between the price, this becomes a valid bullish fair value gap or inefficiency that waits to be filled and rejects to the upside from it. And on downtrend, it's the same logic but in the exact opposite direction. If we connect the lower wick of the first candle with the higher wick of the third candle, and there is clear empty space between price, this becomes a valid bearish fair value gap or inefficiency, the imbalance waiting to get filled and reject down from the gap. And liquidity is the last thing we need to know. We refer to liquidity as zones in price where there are a large number of orders waiting to get filled. These come in form of liquidity sweeps, also known as liquidity traps. The main point of these liquidity sweeps is to deceive the retail traders and to use their buying or selling power for smart money to fill their orders. These traps come in form of equal highs getting taken down just to reverse to the opposite way, and same for equal lows getting taken just for the price to reverse shortly after. These are the two main ways of liquidity being swept. There are a couple more, but less important, that we are not going to talk now, but we sure will do into the charts. So let's jump right now into the charts and finally learn the top-down analysis and how can it be combined with understanding of the price action. On the euro-dollar, starting on the daily time frame, it is important to start analyzing from the top high time frames. Our goal right here is to understand the current trend, and for that, we need to analyze the whole price action, even the beginning of it. The reason is because if we just jump into the most recent price action, in some rare instances, we might have missed a liquidity sweep or something crucial that changes all the trading plan. And we are not lazy. So let's start the analysis. From the initial price action on the left, we got a swing higher high formation, and that basically just continues the last one. So it moves into bullish structure and forms a new higher high. Shortly after, the price pulls back down. Now remember that until this drop, the market was following an uptrend, and we can notice that from the double swing higher high formations. But from this pullback, the market breaks down the swing low, essentially printing a change of character or market structure shift towards the bearish side. So as we know from market structure, when price changes character towards the downside, the market indicates a trend reversal into a downtrend. A downtrend is a price action that forms lower highs and lower lows. And if check the future price action, we got a pullback to the upside, pullback that sets a lower high, basically a high lower than the previous high. And the only validation the market needs to confirm a continuation of the downtrend is a new lower low, one that we get soon after the pullback, and this becomes a bearish break of structure. The price action basically repeats itself and creates a similar structure after, so we got a pullback to the upside. But the pullback does not break the last high, and instead it stopped lower than the last high. So we got a new lower high. And the only thing needed to confirm the continuation of the downtrend is a new lower low. So if we check the future price action, we see something interesting. Price pushes down, but this time without breaking the last lows, and instead it formed a low that was higher than the last low. So this is actually a higher low, and let's mark all of the formations. And after the higher low, we've got a push to the upside that breaks the last lower high. So it has formed a new higher high. By breaking the last highs, we have now got a change of character or market structure shift, but a bullish one this time. And we got the pullback to the downside, with another higher low formation. So now that we got a higher high with a higher low formation, we are confident of the uptrend confirmation. Price keeps forming higher highs and higher lows, with an impulse push to the upside, a push that validates a bullish break of structure. So now we finally arrive to the current price movement. So let's pay attention. Initially from the recent structure, we got a pullback to the downside, and that continues with an upwards movement. We need to question, why did the price push to the upside from this higher low? Well, if we apply the supply and demand concept, We can identify this candle that pushed up with the impulse, and as we know, the candle before the impulse in an uptrend is the demand zone. This also follows our plan of uptrend continuation, because why would we be bearish on this market that is currently in an uptrend? I personally don't like to trade against the main trend, and that in itself is really difficult to succeed on. So if we plan continuation, we would expect a further push to the upside, with a higher high formation related to a new bullish break of structure. So now let's jump into a lower time frame. So we did the macro analysis on the daily time frame. Now we moved into the 4-hour time frame, and we look for opportunities that play towards the bullish side. But first, we also need to fully analyze the recent movements to make sure we did not miss a liquidity sweep that would change the whole plan. Initially, we got a higher highs pushing the price to the upside. Then the next swing high could not break the previous swing high, which creates a new lower high formation. Close to it, the price breaks down the lows, which is basically an internal change of character. And after the break to the downside, the market pulls back up and forms a swing high. So another swing lower high. Afterwards, in the near future, we got a push to the downside, which creates an internal bearish break of structure. Then a pullback to the upside, pullback to the downside, and push towards the local highs, forming an internal higher high. This is a bullish structure. So the internal structure is currently aligned with the external structure. That means that both are following an uptrend. On uptrends, what are the opportunities for high-quality setups? They are demand zones. And where are demand zones located? On the last candle before the impulse towards to the upside, this candle being the one that prints the demand. And we see that this actually broke down the demand, but instantly rejected to the upside. This is a huge indication of a liquidity sweep. And keep in mind that this is not the time frame we are looking to enter a trade, but rather a time frame where we analyze market structure and liquidity. And considering that liquidity sweeps are traps meant to deceive traders just to take the market towards the opposite direction, I am thinking of this wick to the upside being a target to get broken. So we want all of this price action on the lower time frame, basically to create higher highs externally. So let's zoom into this level on the 15-minute time frame. Notice the zoom in of the time frames. We started from the daily time frame, went into the 4-hour time frame, now into the 15-minute, and we can go even further to refine the entry setup. But first, let's shortly analyze the recent price action that should give us clues for the setup plan. So we saw on the higher time frame how the recent candle broke above the last big bearish candle, and this is the action inside that candle. So we got a bullish break of structure formed by breaking internal highs. The break of structure validates the quality of the liquidity entry structures. So we can also apply the demand right here, being the last candle before the impulse to the upside. And we wait for price to fill the demand. Now that the demand got hit, we have the option of taking the trade here, or to refine the entry even more, done by zooming in and looking for the entry setup there. Let's go into the 5-minute chart. Well, let's actually zoom in even more into the 3-minute chart so we can see all available opportunities. Here the price action also looks cleaner. The jumps in time frames are your choice, and they don't matter a lot as long as you zoom in, because that's why it's even called top-down analysis. And what we are able to see on this 3-minute chart is constant breaks of the lower lows and also lower high formations. This happened up until now, when we can finally see a higher high formation that leads to a bullish change of character internally. So now the 3-minute chart is also aligned with the high time frame trend. The market now has a high probability of pushing towards the main trend by basically forming internal higher highs and higher lows until the price breaks the high time frame highs. If you look at this price action, considering a bullish standpoint that was validated by the higher high and higher low formations, we can look for an entry setup. For example, we have a demand zone here, being the last candle before the last upside impulse. So placing a buy long on the demand, I want the stop loss slightly wider because this is a very low time frame chart and it's easier to get trapped and stopped out. And for the take profit, I am looking at around the last lower highs on this time frame, essentially expecting breaks of the highs. And that was how setups can be refined into high quality by constantly analyzing time frames and zooming in until we get a great time frame alignment. Moving into another backtest. At the first glance, we can see how this market on the weekly time frame has this following price action, with initial lower lows and lower highs from a downtrend that later turns into an uptrend. So let's check how it happened and what we can do to find setups that play with the trend. Right? So pull back to the upside, break of the lows, pull back to the upside, breaks of the lows. We mark the last bearish break of structure. And let's check the future price action after. So it's basically forming higher highs and higher lows. The trend slowly turning into an uptrend. We can clearly see here the formation of higher lows, and the upcoming one has it too. With the formation of a higher high on the bullish internal change of character, so the trend is now validated as an uptrend, and that is later confirmed from the push to the upside that breaks the high and creates a new bullish break of structure. But even more important is that here the price finally breaks the last swing lower high. That means that we got a bullish change of character externally. So now we got two indications of the uptrend, both internally and externally. And that's easily observed on the behavior of the price action that just pushed to the upside aggressively and continuously. Now that we've come to the recent price action, we look for the levels. We first need to observe the short-term trend, and that's also bullish and can be seen from the continuation of higher lows, and we even got here a higher low. So now that the price broke to the upside, and we know we have an uptrend formation, our expectation would be for price to continue the uptrend by breaking the external highs, and essentially forming new higher highs. And same as the last setup, if the uptrend validates, we look for demand zones. The demand is the last candle before the impulse to the upside. And on this chart, this is the most recent demand zone, from which we know is valid from how price has behaved once it has filled the demand. So what I mean is that the price hit the zone and instantly rejected to the upside. This is a type of movement we want to see. Now let's zoom in on a lower time frame inside this price range on the demand zone. Into the 4-hour chart first. There's nothing interesting here. We zoom in even more into the 1-hour time frame. Now here we finally can see an interesting price action. For example, we see higher high and higher low formations on the recent price action. Look at the swing lows, how they are being protected, and basically not being broken to the downside, which is a good indication of an internal uptrend. And it also fits well knowing that the higher time frames are also bullish and jumped up from this demand. Let's zoom even further to look for setups into the 15-minute chart. So we basically see the same movement as it should be. Dump to the downside, pull back to the upside. So far a downtrend formation, but not a confirmed one. To confirm a downtrend, the price would have needed to break the swing lows to basically create new lower lows. But instead we see a higher low. So that shows an exhaustion of the sellers. And shortly after we got a push to the upside, followed by a pullback to the downside, the push itself has changed market structure shift into an internal bullish trend. So this is the market alignment with the higher time frame trends. And as we applied before, once the low time frame trend aligns with the high time frame trend, and that was done by that internal change of character, we look for a setup that plays towards uptrend. Usually it validates an entry model like a demand or fair value gap before the break has happened. So we need to observe these entry models before the break happens, but they are being validated only once the market confirms that it looks to follow a certain trend. So in this case, we have a rather small bullish imbalance between these candles. This emptiness in price should be filled at some point, level where we can look for buy-long setups. We are simply just riding the trend. And if we analyze the upcoming price action, it's easy to observe just by looking at the price behavior how it broke into new highs and formed higher lows. That is just the basic uptrend structure just like we know it. But here something interesting happens. This higher low is internally, but we know that there is a bullish imbalance to the downside. Now keep in mind that structures like demand zones, supply zone, and imbalances, they are a priority because they are the zones where smart money place their orders. And if you remember what we mentioned before on what is liquidity and sweeps are, well, they are a concept that says that smart money looks to trap traders before entering their orders, basically using their stop losses as entry points. Knowing that theory, and the fact that retail traders do not take into consideration these gaps and they blindly open orders based on emotions, we can assume that below these higher lows sit a lot of liquidity in form of stop losses and pending orders. I mark them with the dollar sign. And we are going back to short-term analysis, because to confirm our viewpoint, so the price continued to break the last highs, forming new highs. Therefore, obviously, a bullish break of structure. Now there are three scenarios. The first one is for the market to continue what has done before, so that means that it continues the uptrend. The second scenario is for the market to pull back and fill the imbalance, which is the most likely scenario, and continue the uptrend. And the third scenario is for the price to fill the imbalance and continue the downtrend, which is the least likely. However, keep in mind that anything can happen. We are just thinking in terms of probability. And I place the buy-long order on the imbalance. Stop loss slightly below it, or if we are looking for a longer, more swing type of trade, we can place it below the swing lows on this time frame. And for the take profit, we are looking towards a new formation of higher highs, towards the last swing highs on this time frame. I will speed this up. Looks like it takes more than expected. It can happen sometimes, especially that we wanted a more swing type of trade. And there it is. And this is how the price action looks like if we zoom out into the 1-hour chart. A beautiful setup where we also used liquidity implemented into the top-down analysis. And that's all for this video. You have all the resources a trader needs to become profitable on the link in the description or on wap.com/traderslab is if you are serious to learn. And if you liked the video, give us feedback in the comments and give us ideas on what topic should we cover next. Thank you.